Good afternoon, everyone, and welcome to today's webinar, Equity Crowdfunding, the Process, New Rules, Industry Growth, and Why Companies Need Legal Representation. This webinar is hosted by Anthony Millen, Larry Bard, and Paul Jossi. Anthony Millen is a trusted legal and business advisor to startup and emerging growth companies. As a startup attorney, a serial entrepreneur, and a venture capital partner, and the founder and chair of Next, powered by Shulman Rogers. He brings a unique legal and business perspective to advising his clients. Larry Bard, the co-chair of Next, is a highly regarded business attorney whose clients depend on his guidance in corporate finance and securities law matters, including public and private offerings, venture capital transactions, and other financing transactions. He advises companies on issues of corporate governance, business planning, securities law compliance, executive compensation, commercial contracts, and complex joint ventures. Paul Jossi is principal attorney at Jossi P. LLC, which specializes in Jobs Act capital raises. He's also founder of thecrowdfundinglawyers.com, which provides legal commentary on cryptocurrencies, equity crowdfunding, and the Securities and Exchange Commission. Finally, Paul recently accepted an adjunct fellowship with the Competitive Enterprise Institute, where he will research and publish on cryptocurrency and equity crowdfunding policy. During today's presentation, please make note that you can click the Q&A button at the bottom of your screen to submit questions to our panelists. We will respond to as many of these as possible at the end of the presentation, if time permits. You may also submit your questions via email by replying to your registration email. We will also follow up after the webinar by email if necessary. And with that being said, Anthony, the floor is yours.
Great, thank you. And we would like to welcome everybody to today's webinar on raising capital through equity crowdfunding. This is brought to you by Next, powered by Shulman Rogers. And Next is an innovative new model for delivering legal services for the full life cycle of startup and emerging growth companies. At Next, we offer predictable legal fees through more than 75 fixed price packages and service bundles designed specifically for startup and emerging growth companies. Our clients at Next receive guidance from Next senior attorneys through a very high-touch, hands-on legal services model. And we also integrate technology platforms from leading providers like NASDAQ and Carta and UShare and other best-of-breed collaborative tools to create a very collaborative, responsive, transparent, and efficient client-centric experience. For more information on Next, please visit us at www.next.law. And now I will hand it over to Larry Bard.
Thanks, Anthony. And so today's session is all about crowdfunding. And in order to appreciate what crowdfunding is, what I'm going to do is set the table for Paul Jossi, who will be talking more about crowdfunding. I'm going to give us a little bit of a background, a little bit of a history lesson, if you will, a little bit of a sampler of the ways of companies raise capital, knowing at the end we're going to look at that big glass that Paul's got and say, we've had a sample of this, now we want to drink some more of it. So in understanding the regulation of the offering process, really in some ways we go back to the Great Depression and 1933, which was caused in large part by a crash in the stock market. And what we've seen over the last 100 years is a series of economic and political cycles during bad economic cycles. The political winds say we've got to help companies raise capital, and then we see a loosening of the federal securities laws. When bad things happen at first, people say this happened because the securities laws were too lax, and you see a tightening of the federal securities laws. So as we start in 1933, coming out of the Great Depression, Congress says, every issuance of securities has to be registered. That's the heart of the 33 Act 100 years ago, and it's where we are today, except there are exemptions. So it's either registered or it's exempt, or as I like to tell clients, it's illegal. Nobody's doing anything illegal. And for the most part, the registration process means an IPO. So nobody's doing IPOs. There are people doing IPOs, but we are not. And so what we're talking about are the exemptions. How do we raise capital privately without doing an IPO with the SEC? So I'm going to fast forward from 1933 to the 80s. People may have a recollection of what was happening in the US in the 80s. It was a go-go time. And that was the coincided with the adoption of Regulation D, which was a loosening of the registration requirements, of the exemption requirements. And it provided what is and remains to this day the primary vehicle for raising private capital is a Regulation D offering under Rule 506B. And the hallmarks of an offering under 506B are that I see we're getting some political comments. We'll keep those until the end. The hallmarks of a Reg D offering are that there's, and these will be very useful to compare it to what Paul is talking about when we get to CF and we see the benefits of crowdfunding. No general solicitation, no advertising. From the federal securities law perspective, a general solicitation can be something that you may not think is a general solicitation. Obviously, if you see an advertisement on TV, that's a general solicitation. If anybody's going into the office these days and you have your Sirius XM and as you're listening to the news, somebody interrupts to have a commercial for a real estate investment, that's a general solicitation. But we have, putting those aside, we have clients every week that say, I'm just going to put this little note on my website that says, if you're interested in investing, please contact us. That little note on your website is a general solicitation. The federal securities laws take a very broad view of that. You can't have that when you're doing a Reg D offering. For purposes of the 506 Reg D raise, the investors generally are limited to accredited investors. For the most part, that means people that have a high net worth or have had a high level of income in recent years. Reg D offering does allow companies to have up to 35 non-accredited investors. However, if you include non-accredited investors in your Reg D offering under 506B, there's a significant additional disclosure requirements, which turns the offering into a mini unregistered IPO. And without getting too much into the details of what's required when you include unaccredited investors in your Reg D offering, if anybody's ever looked at an IPO prospectus that includes a lot of disclosure, maybe streamline that back, cut it back 75% and say 25% of that is more or less what you would need to get by in a Reg D offering. Some version of financial statements, some version of a description of the business plan, some version of a description of the company's executives and their biographies, a discussion of the company's material contracts, related party transaction, a description of the securities. It becomes quite expensive between the legal work and the accounting work to include that disclosure. And so when you consider it's only 35 people that you're including, they're not accredited, which means they probably are not super wealthy, and therefore they're not probably making big investments. The cost of expanding the Reg D offering to include those investors is almost always not worth it. And that is why you could say in the past 30 years, I think I may have worked on 2 or 3 transactions under Reg D where there were non-accredited investors included. Very, very unusual. So again, you come back from the 30s, you jump forward to the 80s. You have Regulation D. In between Regulation D and the Great Depression. There's also the statute itself, which just says an offering, you can't do a public offering without registration. Regulation D provides what we call a safe harbor. If we do always have clients that may not quite fit exactly in the safe harbor, and we may rely on a legal judgment or opinion that the offering is nevertheless not a public offering, typically not because there has been a general solicitation, but maybe because somebody doesn't technically meet the definition of an accredited investor, or maybe we're just not doing one of the other requirements of a Reg D offering is to file a form with the SEC to say you've done it. So maybe somebody's done an offering that meets that would meet all of the requirements of Regulation D, except for the form filing. And we get comfortable either that we've got what's called substantial compliance with Reg D, so we're good. Or yes, we're aware that no slides are advancing. We haven't quite gotten to the next slide yet. Or we do something that for me and Paul is about one of the most exciting things we do, and we don't do it together, but it's called going naked under the statute. And that's not relying on the safe harbor. It's about as exciting as it gets for a securities lawyer. But now, so like I said, so we go from the 30s to the 80s and Regulation D. A lot happens between the 80s and today, but our next pit stop in history that we want to make is the Great Recession in 2008, 2009, which at first leads to some tightening of the federal securities laws. And then coming out of it, again, the political climate in 2012, we have something called the Jobs Act, and all of your major pieces of federal legislation have to have catchy names and catchy titles. This was the Jumpstart Our Business Act, or the Jobs Act, to create jobs. And as you might expect, it involves some additional loosening of the federal securities laws in terms of facilitating capital raising, growth of small businesses, driving the economy by allowing companies to raise money. And there's two things that come out of the Jobs Act. Almost immediately, we have this change in Regulation D, and that's Rule 506C, very similar to 506B in some ways, but it does allow a general solicitation. So you can do advertising. There's two trade-offs between 506C and 506B. So in order to go with 506C, you're allowed to do your advertising. You're not allowed to take any unaccredited investors, which by itself is not a big deal. As I mentioned, people generally don't take unaccredited investors anyway under Regulation D. But what it does do is it requires you to take reasonable steps to verify the accredited investor status of the investors. What does that mean? For anybody out in the audience that has done a Reg D offering under 506B, you know what this means. When, as part of your investment, your investors make a representation that they're accredited. They may get an accredited investor questionnaire where they check a box and they say, I am accredited because I have a high net worth. I'm accredited because I have a high level of income. And then they sign it and they submit it. That's called self-certification. Self-certification is not allowed under Rule 506C. Rule 506C requires you to take some reasonable steps to verify. So how are you verifying? In some ways, there's a little bit of common sense here. How are you going to verify somebody's income level? You are going to get copies of their tax returns and look at them. How are you going to verify somebody's net worth? You're going to get some statements from them about their liabilities, and then you're going to get their bank statements, their brokerage statements that show the value of their investments. So you will get comfortable. Anthony doesn't like to do this. Paul doesn't like to do this. I don't like to do this. But there is a cottage industry that has grown up around the verification process, and for a very, very nominal fee, they have a portal. And I always, whenever my clients sign up for a 506C verification process, I always go through it myself. It's quite simple. I go in through my phone. I take a picture of my tax return. I upload it. I take a picture of a brokerage statement. I upload it. I get an email that says, we're looking at this. We'll let you know. And then an hour later, I get an email that says, you're verified. I know people that have done the self-verification or the self-certification can be a little bit persnickety about not wanting to share their information, not understanding it. But I think there is a generation of investors that understands the process, and the 506C does work quite smoothly. It can be a little bit of a hiccup for people that don't want to share their information. What else comes out of the Jobs Act? Paul, will flip to the next slide. What else comes out of the Jobs Act, although not implemented as quickly as 506C, is Regulation CF, Regulation Crowdfunding, which really doesn't have, and Paul's going to get into the particulars of this, but it allows the general public, irrespective of your net worth, generally, to invest in advertised capital raising. So this is a huge first. It's in some ways, incremental from Regulation C, but it does allow unaccredited investors, and it does allow advertising. And Paul, why don't we just jump to the next slide, which we'll use as a transition from my portion of the presentation to yours. And it is helpful when we're talking about Regulation CF, because this does come up with some frequency to sort of distinguish, what is Regulation CF about? Equity, people call it equity crowdfunding as a shorthand. It's really selling any securities. They could be debt securities, they could be safes, they could be convertible notes, it could be preferred stock, it could be common stock. But equity crowdfunding is a nice catchphrase to distinguish Regulation CF from other types of fundraising that happen on the internet. It's not Kickstarter, which generally is a pre-sale of some type of novel good or service that's in prototype. Somebody needs money to ramp up production, to move from from their beta type to production, or to move from drawing board to beta, and people are going to get the beta. It's not a GoFundMe where you're out there, I got a great idea, I'm going to save the universe, and people are making donations. Regulation CF involves investors putting in money with a promise of a return. There may be a newfangled bag of chips that come with it. There may be a discount coupon for a product, but at its heart, Regulation CF is about a security. And with that, Paul, I'll turn it over to you. And hopefully, as you're going, people will pick up on the very, very important distinctions and benefits of a Reg CF raise compared to the traditional types of capital raising.
Sure, absolutely. Thank you, Larry, and thank you to Lisa and Anthony and Larry for putting this on, and absolutely thank you to everybody who's taking time out of their day to view this presentation. And I'm very excited to talk about Reg CF and all of the potential benefits. But as Larry said, one of the things that Reg CF is not is a traditional crowdfunding model. These are securities. They are regulated by the Securities and Exchange Commission with all the intricacies and potential pitfalls that comes with. And just to give you an example, when Reg CF first went live in 2016, after the Jobs Act of 2012, when all the regulations went through, the pages for that the SEC put out for it were 715 pages. So that should give you an idea that this is not something where you are just doing a pre-contract with a potential buyer of your product, but this is the big leagues. This is a professionalized, democratized way of investing and capital raising that is new and I think is going to explode here in the next 5 to 10 years. So as Larry said, the Reg CF basics are: you are selling a security, debt, equity, or some combination of the two. They are sold through intermediaries or portals. This is a statutory creation of the Jobs Act of 2012. It's brand new. These things are just coming out. We'll get into some of the portal economics later on, but most of the big ones are in California. The culture there, people really adapted to this quickly. But I think in the trending from here on out, it's going to be more diffuse and more decentralized. The securities that the people buy are, you have to hold on to them generally for 1 year. There are some exceptions to that. Retail investors are subject to individual investment limits due to this weird formula that we can get into if anyone has a question about it. Accredited investors are now not subject to limits, and that's a really good thing because it allows everybody to sort of go into the same pot. You have to have an independent accountant certify your financials. This is another thing that's changed, not necessarily part of the review that came, but as an addendum to it. Unless you're raising below $250,000 where the CEO can certify your financials. Other than that, you're going to have to have a CPA certify, an independent CPA certify your financials, or potentially you're going to have to get an audit. After you raise and you have this big bundle of money, you are not done, unfortunately. You are going to have to file annual reports with the Securities and Exchange Commission. Although there are ways to get out of this reporting requirement after the first year based on your asset level and the number of investors, holders of record that you have. So what are the benefits of doing this, but in contrast to the ways that Larry described through Reg D, which is a venture capital or angel model? Well, I think there are a lot of benefits through doing this. And one of them is you broaden your investor base. You have, as a company, a network of either customers or potential customers. You have people that you know in your lives. And all of these people can now become investors. You have people that believe in you, right? And believe in your team and believe in the company. And all of these people can now become investors in your company, and you can get all of these people economically incentivized and economically aligned with your company, so that the better your company does, the more revenue it produces, the more sales it has, the better everyone around you does. And so you get sort of this organic marketing operation from this that you just don't get with one person writing you a big check, which is, as Larry mentioned, was the way it had been done for decades. So you can turn your customers into your own marketers. One thing that does carry over from the Kickstarter model is you can incentivize investors. You can give them, I always advise people to make it thematic with your industry or with your company, but you can give people non-financial incentives to invest with you, be it a t-shirt or a founder status on your website, or anything that you think will juice this raise and make people feel more a part of your company and your team. You can do that, and people take this stuff seriously. And some people will make a decision whether or not they want to invest in you based on the side perquisites that you offer for people. And so that's a really fun part of this, and it's a really fun way to get your clients or your customers involved in your raise in a way that's not strictly financial. Finally, you can prove value to institutional investors. If you are a company that has a pathway that you want to plan to raise eventually from venture capitalists or even go public later on down the road, you can show these higher level investors that Larry works with the value of your company through these little investors that you have. And you can you even use it as a leveraging tool to say, hey, if I don't get the terms that I want, I can just do another Reg CF or a potentially Reg A plus, which is a higher level crowdfunding mechanism, and bypass venture capitalists altogether. So it gives you more leverage. It makes your seat at the table a lot more comfortable, and it gives you social proof that your concept is working, and that people not only believe in you as customers, but also as investors. So I talked about the portals. Here's a graphic of some of the big ones. I mentioned most of these portals are in California. WeFunder is the biggest by volume. You have Start Engine, Republic, Seed Invest, and Microventures. Microventures is based out of Texas, but the big ones are out there. All of these portals have trade-offs. Some of them specialize in, well, the bigger ones are more general, but they do cater to different audiences. Their investor lists are looking for slightly different things. And then, as you get further down the line there, you will get some of them that are specializing in niche types of investments or industries. And I think as we get to trends, that's one of the things that's really going to expand here over the next decade. So growth so far, COVID was a terrible thing for the world, but for Reg CF, it actually turned out to be a really good thing because so many people were home and they were started to invest online. And you can see some of these numbers here. I mean, Reg CF was taking off even before that, but there's really been an explosive growth since 2020 over the past year. And you can see some of the numbers there, 105% growth from 2019, 75% increase in the number of investors in just 1 year, and the number of companies or issuers that hit their maximum raise that you are allowed to raise by law. And so you're really starting to see awareness of this capital raising tool grow. And you are going to continue to see that as this next slide shows. You can see just the pure growth that Reg CF has undergone over the past year. And I think this one on the right is really indicative, or at least on my right, is really indicative of the exponential growth that Reg CF has undergone. These different points of data are the different marches. The March of fiscal year 2017, the first March, and then you can go to 2021 and see the huge increase there just in the past year. People are becoming aware of this, more people are using it, and obviously, hopefully some of you are going to be incorporating this into your fundraising strategy in the future. This is a graph of the geography. As I mentioned a couple of times, California, this is really big, but there are other places in the country where this is taking off. This is one of the things that I believe is going to change over in the future. Is you're going to see this grow in other parts of the country, and different industries are going to start taking advantage of it as more people become aware and as the industry matures. And here's some industries that have done really well. I know that the one on my left is probably a little bit hard to read, but the main takeaway here is if you have a consumer-facing company, you are at an advantage for capital raising this way, because you already have potential investors that you already know because you're doing business with them. If you're selling a product or you're selling a service, you can turn those people, those clients or customers, into your own investors. So these industries that are doing really well with it are industries that tend to involve the general public and meld your customers and your investors into one big legal bucket. So elements of a successful raise. I know we're limited on time here, but I have talked to people, founders who simply all of their metrics were absolutely great. They had things that would really make for a very successful raise, and unfortunately, they just did not have the full commitment to do this. And so this is again not like one person writing you a check. This is an actual campaign. Everyone has to be on board, and your team has to be committed, and that includes your legal team, but it includes everyone that you know, to get them all rowing in the same direction. And so if you're not committed to this kind of raise, you shouldn't do it, because this takes a commitment, but at the end you get the benefits that we talked about earlier. So I definitely think it's worth it. If you don't have a good product, though, you're not going to have a successful raise. But it's really the people who are really committed to this are the ones that have the most success when they meld that with the really good product. Day one money is another thing. I'll combine day one money and ambassadors, you're looking at a minimum of about a 30-day window to prep this. And as with lots of things, these campaigns are won and lost in the preparation. So you need to really get together some capital that you have in your back pocket when you go live and present to the world. And you also need to have some ambassadors, people that aren't necessarily on your team or part of your company, but people that believe in you, believe in your team, and are willing to not only invest, but also promote your raise out to the general public. And that can be as few as 5 people. It can be as many as, on up. But the more you have of that, the better face that you can present to the larger investor market out there in the world and in the country. And so all of those things need to come together, and you need to have them ready to go on day one to have a successful raise. Portal choice is another one. I talked a little bit about the differentiation between portals. If you just go to a portal, you might think, oh, this is a great portal to be on. The layout is really nice. These companies have raised really well on this portal, but it might not be the best portal for your company or for your industry or for the price point that they are charging to raise, depending on different things like how much you can bring to this raise. So being on the wrong portal may not kill your raise, but you're not going to get the absolute best that you can out of the experience. Publicity and marketing, there's different lines of thought on this. I'm more of a minimalist on paid marketing. There are people that will tell you that you have to have this as part of a successful raise. I'm just not one of them. I mean, you should be aware of it. But to me, if you have a committed team, you've got good product, you've got all of these other things, the paid marketing is a little less important. And finally, experienced legal team. And that's where Shulman Rogers and us come in to help guide you through this process. And we'll get into some of the particulars of what we do for potential clients that are raising through this a little bit later. So here's some success stories. The first success story was a raise that we did together here. Neighborhood Sun allows anyone to power their homes through solar energy, even if they don't own their home, even if they're in a apartment complex or what have you, through trading credits and different legislation. So Neighborhood Sun raised over $1 million on Refunder. They are using that money to expand into different states. And part of their fundraising strategy was, they had the things that we talked about there, and they have now gained this capital, and they are certainly taken off. And that is one that's in our client book here. Here's some other ones. Liquid Piston raised $1 million in 9 hours on Start Engine. That's kind of unusual. That's kind of why I put it in there. Dealey is a company that identifies prostate cancer, raised $1 million on Republic. And Gumroad, an online commerce platform, raised $5 million also on Republic. So you might be thinking, well, Gumroad's a lot different than these other ones. Why were they able to raise so much more? And the reason that they were is that the rules have now changed. Just a couple of months ago, from a vote last November from the Securities and Exchange Commission that went live in the middle of this year, there have been a lot of changes to Reg CF that are going to make it even more attractive for potential companies looking to raise money and for their investors that are looking to back them in their raises. And the first one, the one that sort of is the most eye-catching, is the offer limit was changed from 1.07 million to 5 million per 12 months. And this is obviously a big deal for the number that you can raise, but it also changes the fundraising strategy. Now, in addition to the accredited investors having no limits, you can have one accredited investor or a small group of accredited investors start off your campaign with, say, $1 million or $500,000 and give you really a huge boost to raising whatever your maximum is. Your maximum can be 5 million, but you can have a lower maximum than that if you so choose. The retail investors also had their limits raised. It's still part of the formula, but the bottom line is they are able to raise more than they were able to before, based on either their net worth or annual income. Testing the waters, this is a huge deal. Larry mentioned a little bit about that before. The crowdfunding model, how it really works is you get this momentum, you pre-plan, you have all these people, you come together, and then you face the public and you just go out there and you go do it. And unfortunately, before March, you were very limited in what you could say to the general public and how you could present a potential raise and gauge interest in your raise before you actually went live and filed the paperwork with the Securities and Exchange Commission, chose a portal, those types of things. You're much more open in what you can say now. But it's not a complete free-for-all. You're still somewhat limited. There are things that you shouldn't say. There are mechanisms that you should not use before your paperwork is filed. But the testing the waters tool gives you an added benefit in that you can really explore if this is the right way for you to go by talking to potential investors and people in your circle and in your network before you go through the process of actually doing it. Special purpose vehicles. This was another thing that the industry had been asking for the last 5 years. The SEC finally listened and allowed this. And this is just a fancy way to say all of those retail investors, whether they're only investing $100 or whatever you want to set your minimum to, can now all be placed in one legal bucket on your cap table. And it was really the larger and institutional type investors, the venture capitalists, that said, we don't like this. There are all of these little guys, if you will, on your cap table. This makes it much easier for potential. This makes it much cleaner, basically, for people who want to use this mechanism to have all of these people placed in the same legal bucket and cleans it up. And so this is a different mechanism to use to enhance your raise. There's also a private sector solution to this we can talk about if anyone has a question about it. But this was one issue that got solved. There's maybe one or two others that still need to get solved, but this was a big one. And I mentioned before, CEOs or the head chief officer of your company can now certify raises up to $250,000. This was a response to COVID. It's live until August 2022, and they will evaluate it after that. And as long as there's no fraud or no funny business going on, this will probably be a permanent part of it. But so you do not have to hire an independent CPA if you're raising under $250,000, at least for the time being.
Well, Paul, why don't we pause here for a second on that? Go back to that slide. We had a handful of questions that maybe this slide is a nice jumping off point for. There was one question about comparing the cost of fundraising to a Kickstarter campaign, where Greg mentioned they suggest 25% of the raise is on marketing, and is that the same here? It's a great question. The answer is it's nowhere near 25% of the raise. Your fees and expenses generally are going to be three flavors. One is the accounting cost, as Paul mentioned, that's fixed. So, and then your legal fees, that's fixed. And when I say fixed, it may or may not be a fixed fee. But the first bullet is really critical when you're understanding that. No matter what your legal and accounting fees are, they're the same for a $1 million raise as they are for a $5 million raise. So your cost of raising the capital as a result of the new rules as a percentage of the amount raised goes down significantly if you're able to raise the full $5 million. Now your platform may get 4, 5, 6%. Paul can tell you what the current market is of your raise and a combination of cash and equity. That's going to be a constant. So that's going to be, if it's 5%, that's going to be 5% of the million or 5% of the 5 million. But your legal and accounting will go from potentially being, a not de minimis piece of a $1 million raise to being really a de minimis piece of a $5 million raise, and really brings the crowdfunding economics, I think, in line with a Reg D raise, where you're paying a broker to find investors, which may be 5 or 10%.
Yeah, and you bring up a really good point about the accounting. I forgot to mention this because this was kind of a quirk that even the big portals were caught off guard with. Is people just assumed, well, first of all, when you do this, when you do your accounting part, it's really going to vary on how complicated your structure is, how long you've been in business. It will go up to 2 years. But the big thing was in the original Jobs Act regulations, or original SEC regulations, they basically gave you a freebie for not having to do an audit on your first raise. And then you would have to do it afterwards if you were raising over 535. But they did not incorporate that freebie into the new rules. So if you are raising over $1 million, you will have to get that audit even on your first try. And some people are kind of taken aback by that. And it is going to increase the amount that you're going to have to do, the amount of accounting costs you're going to have to do upfront. So a lot of people are just really sticking with that first $1 million on the first try, and then potentially going later on where you're going to have to do an audit either way for a subsequent raise.
And then, Paul, we had another question again that I think interrelates nicely to the SPV bullet, and that was, I think somebody, forgive me on the name, but somebody said, well, I've heard that VCs don't like this. I guess there's 2 or 3 responses that, yes, everybody heard that, but was that just VCs, being adverse to the competition that CF creates? That will be a cynic's view. I don't know that I've seen a company that's come through a crowd fund, then go do a professional raise under Reg D and have VC say, I'm not interested. So whatever adverse reaction people may have, it seems to me, number one, it's probably more theoretical than a VC is not going to look at a good investment if it's the next Google, the next Apple, and say, geez, I really would like to invest in this, but you've got 100 people that you brought in a crowdfunding, so I'm going to take a pass. That's number one. And then number 2 is the industry. That was, again, sort of the first take on all of this, that sort of set some roots and expectations and mindset. But the industry did come up with a number of features, the SPV being the most recent one, to sort of make the small investor as legally outside of the realm of the governance structure of the issuer as possible. The SPV, again, being the most recent, but what we have also seen is, other than straight common stock issuances, of which there have been under CF, many of the instruments that are used in CF attempt to divorce some level of ownership, some level of voting power from the economics by appointing a trustee or a proxy, maybe the company's CEO, as the right to vote the shares. We've seen a class of non-voting securities, and all of those things along the way. Paul, I don't know if you have other thoughts on that question.
Well, yeah, I just have one thought on not the latter part, but on the first part about the industry, friction there, and part of it is, I would say, is also a generational thing, where people who have been doing venture capital for all their lives, they don't want to see that, and maybe they should stop living in 1987, and people that are sort of a little bit younger and sort of have a different view of looking at this. markets.
Yeah, yeah. Then we had another question that's not directly on this slide, but while we're addressing some of the questions, maybe we'll cover them. There was a question about, can an investor outside of the U.S. participate in a crowd fund? It's a great question. The answer is no. Crowdfunding is an exemption from the registration requirements in the U.S. It may very well be that Japan or Singapore or Gibraltar, says investors here can participate in that, in which case it would be okay. The U.S. government doesn't say investors outside of the U.S. can't participate here. And Lisa is telling me that the question was, can a non-U.S. company use CF? It's the same issue as investors. So if you have a company in France that wants to raise money in the U.S. markets are going to say, fine, that's wonderful, you can do it. The question is whether there's anything in local law that prohibits a company from reaching outside of its jurisdiction to raise funds this way. And we get the same question on all of our Reg D offerings. On almost all of them, somebody comes in and says, I have an uncle, I have a cousin, I have an aunt in London, in Paris, in Tokyo that wants to participate. And the answer is we always have to sort of give a quick ring to local counsel and say, just want to make sure this is okay. Are there any filing requirements? Are there any investor requirements that are similar to our accredited investor standards and the like? And I think there was one more question from Raymond about the historic amounts that were raised under crowdfunding. And Raymond, Paul may know the particular answer for years, but I think the key is Paul's slide that showed, as a result of the pandemic and people being home and having time to invest, that it really last year took off astronomically, logarithmically, if you will. And so the historic numbers were relatively small. Even 2019 wasn't so great. It was fun for us people that were doing it, but 2020 was really a tsunami or a tidal wave, whatever you want to call it, in terms of volume.
Yeah, and honestly, it is still small if you compare it to Reg D. I mean, Reg D is about 1.5 trillion annually. That's where most of the investment still goes in America. And there are trade-offs, there are disadvantages of that, geographic and what have you. I'll get to some of that in a little bit. But Reg CF is gaining. Now it's still a very small share of the total private capital market. But look out for it in the next 5 to 10 years.
Right. And then one more question. Can public companies use Reg CF? I don't believe they can. And then Paul's shaking his head in agreement, not in disagreement with my answer, in agreement with my answer. Paul, do you want to, I interrupted you. I thought that was a nice jumping off point for some of the accumulated questions. You want to go on to slide 16?
Sure. So that's actually kind of along the same lines of the things that we've been talking about, some of the changes and the trends I think that are going to happen over the next decade or so. One of them is legal, and that is a preemption on secondary trading. We mentioned about how these securities are restricted for retail investors when you have to hold them for a year. After that, on the federal level, they are freely tradable. You can do whatever you want with them. But unfortunately, you also have to, at this moment, follow state laws, which can be very difficult and not a lot of fun. And so they are not freely tradable on the state level. There are ways that you can do it, but it's going to potentially give you a lot of headaches. Now, this is emerging. This is one of the things that is going to, the SEC, by the way, this is one of the things that people have been asking for that the SEC did not solve in these in the recent review. But it is something, there were like 3 footnotes in the release that came out in November. And so they are very aware of this. They're aware that it's an issue. It's probably going to go through a formal notice and comment period. And there are going to be people at the state level that oppose it. But I think eventually you are going to see this where these private securities that are purchased through Reg CF or Reg A Plus are going to be freely tradable. And the SEC is just going to preempt the states and say, you just can't involve yourself in this unless it's a notice fee or fraud. That is going to potentially open the door for more crypto involvement because, crypto is all about having things, the liquidity of it, and it'll also help the investors on the liquidity side. Geographic and demographic diversity. I think you're going to see this spread throughout the country in places that don't normally, where these Reg D investors, these venture capitalists normally are. The rest of the country is kind of forgotten when it comes to capital raising, and I think Reg CF is going to be part of the story that changes that. Also, demographic diversity. Maybe founders that weren't necessarily part of the venture capital story now have a way to go around them, or to, as we said, prove themselves to those people if they want to. But this is going to open up opportunities for people and places that normally aren't part of the capital raising story unless you want to go to your local bank. So that's going to be, I think, a huge trend in the coming years. And that's going to include, it doesn't have to be the next Google. It doesn't have to be the next Microsoft. It can be a local franchise restaurant that has 2 or 3 restaurants in Oklahoma or, where I'm from, Louisiana. And they can use this to gain capital, to expand and that sort of thing, or any other kind of retail or brick and mortar type of business. Innovative financial instruments. I think this is really interesting. Larry talked about a lot of these are not going through common stock. I think there's going to be interesting things like revenue shares and notes where the issuer, the company says, look, we're going to give you a part of our revenue based on a multiplier until you're paid off over the next few years. And that way you're not getting equity, but you're getting an immediate or close to immediate return. And the company says, after this small amount of time, we don't have any obligations to you in a good way. So it'll be available for everybody to sort of come together in a way, but lessens the burdens on the company going forward as far as a compliance goes, and gets the investors an immediate return. It's kind of easy to understand. It's simple. And I think that's going to be a big part of this going forward.
This will be, Paul, when Mr. Wonderful starts to participate in our crowdfunding investments.
Absolutely. And so another thing is portal specialization. So you have right now you have these huge portals out in California, and companies, I think, are already, but in the future will tend to get lost in these big portals. Even though they have these huge investor lists, they're also competing for attention with a lot of other companies. And so I think you'll see a diversification and a specialization in the portals. You might have a restaurant portal. You might have, cannabis, or other kinds of entertainment, movies, things that have a particular audience that likes that particular thing, and will gravitate towards that. And so you'll see a bit of diversification there as well. And also the venture capitalists and the incubators will start to align their fundraising strategies with this. Telling companies, hey, go out and do a successful Reg CF, then come back to us, prove to us that you've done this. Or the incubators will, at the end of their session there or their course, will have someone come in and say, look, this is an available mechanism for you to get your raise off the ground and allow you to take off with potentially investors and backers, located throughout all the country. So these are some of the things that I think are going to change here in the next 5 to 10 years.
And then Paul, on your last slide, your heading is very subtle. No, the one, I'm sorry, the why to hire your lawyer's first page,
Okay.
page 18. I mean, at least once, and I'll let you, Paul, sort of, take the slide, but at least once a week between us and Paul, we've got a client that's calling us, talking about a crowdfunding, saying, in a best case scenario, that they heard from the portal that they don't need to hire a lawyer, or in a worst case scenario, that they've started a crowdfunding without a lawyer, and now they've got questions about it, and so that really sort of, I think, Paul, led to your slide, which is wonderful. And I'll let you sort of go through the points and tag team with you a little bit.
Yeah. So one of the things, and I've been on calls with portals, with the account manager for that particular company, and they will say something like, "We handle the legal for you," and what they mean by that is they're going to give you a template for a subscription agreement, and they're going to do the filing with the SEC, and it's good that they do that. And, I'm not here to bash the portals. They perform a very good service and a valuable service, but they are not your lawyer. And they are not going to be there to answer the legal questions. And they are not going to be there to detail the Form C, the risks that you're going to have to do. And they are not going to be there for your protection. And so there are various amounts of things that the lawyer is going to do for you through this process. And then one of the most obvious is the legal paperwork. And that is what's called the Form C, which is the legal document, usually comes out to be about 40 to 60 pages or so. And the subscription agreement, which is really important because that's what the investor is getting, and that's what the company is giving. And so everyone will be able to pull up, you can Google a template for that if you want to, but that is not going to be tailored to your raise, to your company, to your industry. But beyond that, beyond the paperwork and the particularly for the risks and the subscription agreement, there are going to be questions that come up throughout this raise, and that will include potential investor questions. They will have the opportunity to interact with you on the portal page. They will have the opportunity to ask you questions about the investment. Some of the questions will be business related, and those are things that the company will handle. But other questions are going to be about the investments and the intricacies of the investment. And those are things you're not going to be able to talk to the portal about. So one of the things that we do after we've done the raise, and we are there for you through all of the live process of this raise until you get the money wired to you, is we answer things like, questions that come up from potential investors, what you should say and what you cannot say outside the portal, terms, non-terms communications, things that you need to be aware of that will potentially trip you up, because the SEC is not the IRS, but it's not that far away from it. It's not a federal agency that is going to be very much fun to get entangled with. And so ideally what you want is to have that paperwork filed with the SEC, have that raise closed, and have no one else ever have to look at it again. And that's what we are here for, as well as bringing awareness to your raise. Shulman Rogers has an email list of potential people that they interact with through their business. I have a website that gets a certain amount of unique visitors every day and every week. And so we will also help you with the non-legal stuff, bringing awareness to your raise and doing all of the things that you might not want to do, so you can concentrate on the particulars of the campaign and, all at the same time running your business.
And the other thing, Paul, I'll just add maybe as a last word here, is the interrelation between your crowdfunding and your other capital raising activities. What can happen at the same time? What has to stop before you start your crowdfunding? and what can you start and how long after the end of your crowdfunding, all sort of the concept of looking at your capital raising as a holistic strategy rather than just sort of something that happens in isolation.
Absolutely. And, I'd just like to thank everyone for listening to the presentation. And, it's the middle of the day, it's beautiful outside. And so hopefully we informed you here, and, you can get in touch with us if you have any further interest.
Great. And I would just like to thank Larry and Paul for an incredibly informative presentation today and also to thank everyone who joined us. As Lisa posted, everyone who registered will receive a copy of the presentation and the recording. And on behalf of Next, powered by Shulman Rogers, we also welcome you to take a look and see what we offer at www.next.law, and for some of our other educational programs, and to follow us on LinkedIn. Thank you, everybody, for joining today.